But I think it's going to be even more apparent in this next crisis that that stimulus is just not going to be enough. And so, I think that's going to play into it as well. People realizing that they need to protect themselves.
Hey there, Silverbug. What do you get when you combine SD bullion and the New Zealand Mint? You get the lowest price silver coin ever released to the world. Introducing the Roaring Lion, a 1 ounce, 4 nines fine silver coin with micro engraving security that retails for lower than some of our competitors sell silver bullion rounds for. Check out this magnificent beast, the Roaring Lion silver coin, at sdbullion.com/roaring. That's sdbullion.com/roaring. All right, all right, all right.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is Matt from the Silver Fortune YouTube channel. Matt, thank you so much for joining us today.
Good morning, Elijah. It's great to speak with you again.
Definitely. Now, the first topic I'd like to discuss is the precious metal prices, because over the past couple of weeks, we've seen a significant downturn in precious metal prices. We were seeing quite a big rise in precious metals since really it seemed like maybe November. But now we've seen a significant downturn, and you've made a video recently talking about how this is more than noise. It is a significant downturn. So what is your perspective on this?
Yeah, sure. I mean, if you look far enough back, if you look over the last 5 years, you could say that this is noise. But if you're looking at it more specifically, if you're going to say that silver and gold, they bottomed out in the end of 2018, and that kind of marks the end of this bear market, that a new bull market started, sometime in November. Then if you're just looking at it over that 6 months or 3 months time span, then yeah, this is, I think, a pretty significant pullback. I mean, the one that I'm particularly watching right now is gold versus silver, and I'll explain that here in a second. But gold was, knocking the door of 1350. It was just shy of that, which has been a key resistance level in the past. And after the rally on the Fed news and just as a whole, the bull market the move up that had started in the middle of November, it was kind of expected that gold was maybe going to pull back some, but I was surprised by how much it pulled back, not just back to 1320 or 1310, but actually below 1300. I think it was it was in the 1280 range there for a while, which, technically speaking, if we're talking about technicals, it is a pretty significant pullback. It moved right through that, what was then a support level of, 13 or 1303. So I do see it as pretty significant. Now, since then, we're seeing gold move up, and it's just, as we speak, actually just shy of 1300. Now, if it can move consistently back up above 1300, I think that would, again, be a pretty key, what is now a resistance level, be a key resistance level to move through. And then we can say that, well, this pullback was maybe a little overstated. It was a bit of a knee-jerk reaction or whatever. I think a lot of the same factors that we talked about for so long for silver and gold in terms of why this next bull market could be right around the corner, those are still in play. I mean, the Fed is still moving on an easing path, right? We had this recent jobs report that came out. I think last Friday, that was very poor. It was not even close to expectations. Now it's just 1 month. That's more ammo for the Fed in their next meeting to most likely not raise rates. I don't think anyone's expecting them to raise rates in their March meeting, but also set a timetable for the end of quantitative tightening. Right? They're moving in an easing direction. And none of that has changed, right? We have the Atlanta Fed come out with their quarter one. They're updating their quarter one GDP projections, and they're pretty close to 0% now. I mean, there's no way the Fed is going to at all come out and give a hawkish slant in their next meeting. And so I think these same factors are in play. Now, notice I'm mostly talking about gold here, and that's just because, I think, if you're looking at the gold to silver ratio, or if you're just looking at gold and silver and how they're performing versus each other, and even where they were a year ago. A year ago, gold was a little higher than it is right now, north of 1,300, so 1320, 1330, around that level. Silver was a full dollar higher than where it's at right now. So since then, I mean, it's not so much that gold has outperformed silver. It's just that silver really underperformed gold during that down period in the second half of 2018. And now I think, for if we're ever going to be talking about $17 silver, 18, 20, 21, 22, and et cetera, I think the conversation first has to be shifted to gold. When can gold break 1,300? I mean, that's the first step, which it's, just on the cusp of right now. When can it move through that key resistance of 1350, 1360, and then finally 1400? So, in that time span, let's say this bull market or this move up continues at least until summertime, until June, let's say, and gold can somehow move to just shy of 1400. I expect silver to somewhat outperform gold during that time span. So maybe we'll be looking at a gold to silver ratio of 80-1. That's in contrast of 84 roughly to 1 right now, maybe 75-1. But really, if you're really looking at silver, when is it going to take off? When is it going to move above some of its key levels, whether that's $20 or 21 something or 22 something, up to 25, 30, et cetera. I'm waiting for gold to move north of 1,400. And then I think we're really going to see that outperformance from silver that we've seen in the past. We saw it in 2011. We've seen it in the past where silver, a little more volatile, smaller market that we're talking about here. It tends to move down more than gold, but when they're in a bull market, it tends to move up more, and I think we're going to see that here. It's just a matter of when can gold really get moving and kind of get out of this funk that it's been in for 5 years and counting now.
Definitely, and you've also said that you see in about the next 5 years, increase in popularity of silver stacking. So investing in physical silver. Is that kind of related to the rise in price you see going forward?
Well, yeah. I mean, you talk to, and partly, you talk to any, silver and gold dealer, right? If you talk to your friends over at SD Bullion or APMEX or whatever, and you ask them, what is it that sells silver and gold? Primarily, what they are looking for is price drops, significant price drops, where people see it as a bargain or a good entry point into the metals. A good time to add additional amounts to their physical holdings, or big moves up, right? You have a lot of stackers that have been buying at these low prices for a long time now, but I think, with a big move up, you'll get a lot of popularity that will, kind of spread. I'm not by any means saying that we're going to see, a tenth of the U.S. population or the Western world stacking silver and gold. A double from what it's at right now is still a relatively small segment of the population. But I think a big move up, not unlike back in 2008 through 2011, could lead to a big increase in the popularity. But, I think it's more than just the price. I mean, you look at what was happening during that time span from 2008 to 2011 when we saw this big jump in silver, physical silver demand. It was what's going on in the economy, what's going on in the financial system. And I think, I'm not going to come out and say we're going to have a recession or a depression or a stock market crash in the next 12 months or something like that, make a very specific prediction. But I don't think it's a stretch to say that we're not going to have to wait a full 5 years for that to happen. And I think that when this next crisis occurs, it's going to be global. It's going to be, I think, much worse than the financial crisis. And I think we're going to have some of those same dynamics in play. I'm not talking half the population, a quarter, a tenth. Again, the population so worried that they're going to go out and buy physical bullion. But there's going to be enough people that wake up and realize, just like they woke up back in 2008, 2009, and realize this system is doomed. The Fed, the government, they can patch over it over the short term. They can try and inject some more stimulus. But I think it's going to be even more apparent in this next crisis that stimulus is just not going to be enough. And so, I think that's going to play into it as well. People realizing that they need to protect themselves, that their job, their house, those things are not guaranteed. Their retirement certainly is not, whether it's a 401k, an IRA, or even pension plans, which are in a world of trouble right now. None of those things are guaranteed. Social Security, even potentially basic services from the government, none of those things are guaranteed into the future, and so they need to take some responsibility for themselves. I don't think it's going to be a huge societal awakening. I think the vast majority of people actually will move further in that direction, that when they lose their job, they'll lose their house, they'll look to the government to help them out with those things. But there'll be enough people, I think, that wake up and realize whatever you want to call it, financial prepping or prepping as a whole is something that's necessary in these times.
You've recently talked about how the next crisis, you talk about just right now, how it probably won't be in the next maybe year or two, but maybe, 5 years down the road, it's not that unforeseeable that, within 5 years it could happen. And you've talked about how a lot of people expect it to arrive very, very soon. So, like in the next year or so, but really it'll take longer than people expect. Can you expand on why?
Yeah, well, I think what you might be getting at is, so I put out this video. Now I should clarify. It could happen in the next year. It could happen in the next 6 months. Most of the pieces, I would say, are in place. It doesn't look like it's going to happen in the next week or the next month or something like that. But most of the pieces are still in place for this thing to happen, whatever this crisis ultimately looks like. But I put out a piece of work last week, and I think it was titled "The 6 Rules for the Next Crisis." And I kind of went through some rules of thumb that we can watch for this next crisis and how to evaluate it. And so basically the idea behind it was that, first of all, this next crisis can take longer than most people expect to ultimately arrive. And I mean, this goes back to 2000, right after the Great Recession, people were expecting another crisis around the corner. It never happened, right? We had maybe, you could call what's happened maybe in some years in Europe, pretty close to crises, but in the United States, not so much. It's taken longer than I think most people expected, including myself, to arrive. But, the second rule that I gave there was that it's going to unravel much faster than most people expect. That this isn't going to be some drawn out linear. This is going to be a very rapidly moving time period, rapidly evolving, not unlike how it was during the financial crisis. The third rule there was that it won't be different this time around, meaning that there's going to be some kind of universal truths or some universal similarities between what happened last time, what happened this time, how central banks and governments will react, how the average person, the middle class, et cetera, will fare, i.e., they're going to be squeezed even more, they're going to lose more wealth, whereas the top 1% are probably going to accumulate wealth, as they tend to do during both good and bad times. But then the fourth rule was that it won't be the same as last time, in the sense that I think I can say pretty confidently that this next crisis is not going to originate in the subprime market. Now, maybe there's a bubble in the subprime market, maybe that can contribute to it, but I think it's going to be certainly different than that. Number 5 on this list was that economic, geopolitical, political, and societal factors are all going to affect each other. And so I think the example I gave is, let's say we have a recession in the next 12 months, a bad one, right? A big crash in the stock market. That's going to affect, obviously, the economic outlook, and it's going to affect societal factors. People are going to be upset. They're going to be out of work, et cetera. But you're going to, I think, see that extend into the political realm. People are going to be upset for the 2020 elections. That puts, I think, Trump's re-election into question, depending on how he handles it. And then you're going to have geopolitical reactions, whether that is more trade wars, more animosity between the United States and countries like China or the EU. All of those things play into each other, and it's kind of a self-reinforcing cycle that they continuously go around and affect each other, right? So if we have a trade war escalation with China, then obviously that's going to affect the economic realm again, right? Or it's going to affect the political realm. So that was kind of rule number 5. And then finally, number 6 was that there will be blood on the streets. And maybe that is, people can take that literally, it can actually get that bad. But most of them talked about in the financial sense that there's going to be assets out there that are going to be hated. And I don't think this time around it's going to be silver and gold. We could see that, that acute crash like we saw in 2008. Sure. But I'm thinking more of the other assets that we saw really crash after 2008, 2009, stocks and real estate and the like, which, I get it. Some viewers, some listeners might be turned off to the idea of buying stocks, buying a paper asset or something like that. But, certainly I think it's an improvement over bonds or fiat currency or something. But I think that there will be a time and period that there will be blood on the streets when everyone, including yourself, your gut, your emotions are telling you to hunker down, to hold that gold and silver through to the end. But, looking back at 2008, 2009, it's in retrospect is 2020, but buying, let's see here, on March, 10th, 2009, we're actually 10 years out from the bottom of the S&P. Buying then was about the best time to buy, and that was when everybody else was selling. That's when nobody wanted to buy for the most part. So I think it's going to happen again. It could be much worse, right? And obviously there's some risk. You don't want to, catch the proverbial falling knife, meaning buy at 500 in the S&P and it falls to 200, just to give ballpark numbers or something. But I think that's something to keep in mind, and then you want to have a plan beforehand. And that's kind of the whole idea behind this, that there's people out there that are going to try and time this. Going back to the first 2 points, that's going to take longer than most people expect to arrive, but it's going to unravel faster than most people expect when it finally does arrive. There's people out there trying to time this thing. But I think the big takeaway is that for the average person that doesn't have the inside track on this knowledge is, you want to get prepared beforehand. You want to be in a good position for this to go off yesterday, right? And to be in a reasonable position to, I guess, succeed, whatever that means for you in this next crisis.
Now, you've talked about how there are many potential catalysts for the next crisis. And one of them that you've talked about that is really misunderstood and you think is a lot more urgent than people think is the U.S. debt. Can you expand on this?
Right. It's tough because it's almost like beating a dead horse. Like I think it's like a rule of thumb. You can't have a YouTube channel. You can't have you can't write in this space. You can't do interviews in this space without mentioning the U.S. debt. Everybody talks about it and how big of a problem it is. And they're right. But the problem, unfortunately, is that most people have kind of become immune to that they've heard this going back to the 1990s, 1980s, probably before that, talk of the U.S. debt and how big of a problem it is. And for me, I guess it's I get that, and I don't want to be too alarmist here. I'm not saying that this is all going to fall apart, but I think that the U.S. debt historically, dating back to 2000, has moved up in an exponential manner, and I don't think that's going to end. And I see right now, I guess the big misunderstanding that I think a lot of people make when it comes to U.S. debt is they look at the number. They look at 22 trillion or the deficit, $1 trillion plus each year, and they ask themselves how much higher will it go and et cetera. But I think the really important thing to understand when it comes to U.S. debt, just like with any U.S. debt market, is that it's not just the U.S. government issuing these bonds, issuing this debt, and we have to worry about that. There's the other party involved. Who is it that's buying this debt? And that's the question I think people really need to start asking. I think that's a big question with this next, U.S. debt crisis, whenever it ultimately arrives. The big question is, who is going to buy it? Because, in the last year, I think 2018, we saw the U.S. debt go up by, it varies, I think 1.4 trillion, 1.5, 1.3. I've seen, and I think the Treasury reports something much lower than that for their official deficit. But as a whole, you're looking at who's buying and who's selling U.S. Treasury debt. And during that time span, it wasn't foreign investors. As a whole, both private foreign investors and foreign governments or central banks, they sold U.S. debt, a small amount, but they did sell it. The Fed, obviously, they're not buying U.S. debt right now. They're not running a QE program. They're running a quantitative tightening program, meaning that they're decreasing their Treasury holdings. And then you have like U.S. Pension funds and whatnot, U.S. government pension funds and whatnot. They are, they're buying a very small amount of U.S. debt, U.S. Treasury bonds. As a whole, over $1 trillion worth of the total amount of bonds that were issued in 2018. Now, I figured if this was 2018 or fiscal year 2018, but either way, over $1 trillion of that was bought by domestic investors. So you have hedge funds, large banks, pension funds, and the like, and of course private investors, households, et cetera. So I mean, primarily it's banks and households when you look at it that own or bought most of this debt, and their ability to buy this debt going forward is very limited. This is over $1 trillion that they bought in 1 year. As a whole, this segment, the domestic investors, only own something like $7.5 trillion worth of debt. That was a massive accumulation, and their ability to continue with that pace of buying at current prices is very limited. Right. And so if we're going to move into a realm where deficits of $1.5 to $2 trillion are the norm, you got to ask yourself, who's going to buy that debt? And it's going to have to be the Fed at some point through their QE programs. But even then, I mean, is that going to encourage other foreign holders or even domestic holders of U.S. debt to sell their debt because they see the problem with that. They see the inflation that's going to occur because of that. Or you look at a country like China. China is the first or the second largest holder of U.S. Treasury debt, roughly $1 trillion worth. And you ask yourself, are they going to sell that in the future? Now, right now, they don't have a whole lot of reason to, I guess, motive to sell it at this point. It's a significant portion of their Forex reserves, which are very important for their currency, which has historically suffered from a lot of weakness. But you ask yourself in the future, I mean, if China's debt problem blows up roughly around the same time that the U.S.'s does, are they going to have to defend their currency? And are we going to be talking about them defending, not the 7-to-1, but maybe the 8-to-1 or 9-to-1 level for the yuan to the U.S. dollar? And if that's the case, then they're going to have to be selling some of their Forex reserves and their treasury bonds, U.S. Treasury bonds, and that further adds to the supply in the market, right? I think this is it comes down to this prediction that I saw from this model that was actually put up by Alistair McLeod, talking about how over the next roughly 10 years, we're going to see something like $30 trillion. This is accounting for recession, but $30 trillion added to the U.S. deficit over the next 10 years. Who's going to buy that? Foreign investors, domestic investors, they only can account for so much of it, and it's going to have to be the Fed in the end. But that's not a sustainable program either. Fed doubling their balance sheet, tripling their balance sheet, they can do it. They can fund those deficits indefinitely. We know that, but at what cost to the strength of the dollar? And so, I think this is really urgent, not in the sense that we have to watch us day to day or something like that, but I think that in this next crisis, as we see deficits balloon again, it's going to be at the forefront of many analysts' minds, as well as those that work within the government, because there's going to be a sovereign debt crisis element to this next overall crisis. Now, does it start there or not? We'll see, but it's going to be part of the discussion, and the Fed is ultimately going to have to monetize a lot of that debt, which again, brings us back to why. The dollar is a pretty good bet to fall in the next crisis, and why silver and gold can continue to be seen as the safe haven asset because of QE, because of 0% interest rate policies, because of the U.S. debt crisis that's eventually going to come.
Now, to wrap up here, what is your perspective on what people can do right now? You were talking about how in this next crisis, a lot of people will ask the government to save them. But what are ways that people can protect themselves right now so that we don't ask for the government to save us and, so we don't have more of our liberty taken away?
Well, yeah, you're absolutely right. I mean, those two things go hand in hand. If you're going to ask the government to help you with problems A, B, and C, then you're also giving away liberties, D, E, and F. And so you're right. We do need to find some way to become more self-reliant. And I'm sure many of your listeners are familiar with the financial aspect of it, whether we're talking about silver and gold or physical cash or whatever it is to remove themselves to some extent from the system to become more self-reliant financially. Sure, that's part of it. And then there's the other piece of it, the prepping piece of it, the skills and the tools, whether that's making sure you have appropriate shelter, fuel, protection, firearms or otherwise, food, clean water source, potentially clean energy, just energy in general. Wind or solar or something like that. Those things are important as well. But I would say, those two get a ton of focus. And the two things that I focus on a lot that don't get as much focus would be mental preparation and your community. So first of all, mental preparation. This is something I talk about a lot as being perhaps more important than all of those other things. If you have somebody that is mentally prepared but may not necessarily have all the tools, all the resources to survive as well as somebody else, they still put themselves in a better position than the vast majority of the population who is not at all mentally prepared for, I think, what's going to come. But second of all, you also have the community piece of it. The idea that we as humans don't survive or certainly thrive as well as individuals, and that as a community we make ourselves stronger, both in a I guess an emotional sense, but also in a very real, tangible sense as well. Whether this comes down to sharing resources or protection or whatnot. Now, this is by no means talking about how you should just find your nearest neighbor and make friends with them and then depend on them in the next crisis. I think that's a pretty bad plan if you're just selecting people randomly or selecting people based on their proximity to you, because those people are more likely than not going to be leeching off of you. They're going to not hold the same values as you, and they're not going to be, as I said earlier, mentally prepared. You want to find people that are, like-minded and are on the same sort of preparedness path, whatever that might be for your individual community. I think there's a ton of benefits to it. In fact, I've heard this said in the past that, when we're talking about government, and I think most in this community would be against the idea of socialism or communism or fascism. Those things are not necessarily bad when you get to smaller and smaller communities. Now, yes, people need to pull their own weight. Yes, we know the story of, what was it, Jamestown, or one of those settlements where they tried socialism and it absolutely failed because nobody did their work. But you look at something like the nuclear family, like a mom and a dad and the children. I mean, the children are basically welfare recipients, right? They don't pull their own weight. They get the food, they get the shelter and whatever. And that's I mean, I guess socialism on a very small scale. It can be very damaging on a large scale, but on a smaller scale, some of these types of sharing of resources, sharing of whatever with people you trust, people people that hold the same values as you, can be a very valuable way to increase your chances of not just surviving, but also thriving through this next crisis. And as you said, relying less on the government and retaining your liberties that you otherwise would have lost.
All right. Well, Matt, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Yeah, you guys can find me over on Silver Fortune on YouTube. I'm also on most major podcasting platforms, iTunes, Android, Spotify, etc. So you can check me out there as well. Otherwise, I would say that right now, if we're looking at the global economic space, the global markets, it seems like this would be an easy time to be kind of lulled to sleep. Markets continuously kind of move up with pretty low volatility. Silver and gold are not doing a whole lot. There's not huge, exclamation points in the political realm, and yet, I think it's a good time to, as I said earlier, prepare in all these different ways, but also to remain vigilant. You can recall back to a little over a year ago when we had a massive run up in the stock market, which ultimately collapsed, then in February, and everybody was kind of surprised by it. And yet oftentimes it's, what does the old saying go that bear markets, bull markets are the author of bear markets, and bear markets are the author of bull markets. Well, these low volatility, these kind of boring periods, mundane periods, they're the ones that kind of write the next interesting period, I guess, whether we're talking about the markets or the economy or whatever. And I think it's important to remain vigilant, even if things can kind of seem low key right now. And I think that's something important to keep in mind.
Definitely. Once again, Matt, thank you so much for your time.
Absolutely. Thanks for having me on, Elijah.